Hey, Bowtie Nation, Joseph Hogue with the biggest opportunity of the year for dividend investors, the Schwab U.S. Dividend Equity ETF, the SCHD, easily one of the most popular dividend funds for income investors, just reshuffled the deck and is ready to deal out more dividends. Most investors have no idea what actually changed. Big names like Cisco Systems, CSCO, and AbbVie, ABVA, were trashed while surprising stocks were added, like United Health Group, ticker UNH, and Macy's. I've got Mr. SCHD himself, Mark Roussin, here from the Mark Roussin channel, here to talk about the changes, explain why the SCHD dropped some and then picked up others, the biggest surprises, and how it sets this ETF up for paying those dividends. So, Mark, thank you for joining me. I appreciate it. I know you are the SCHD expert here on YouTube, so I wanted to get your input onto this reconstitution. It's called. What was dropped, what was picked up, some of your biggest surprises in this. So let's start off with just what is the SCHD? How does that work? And what investors would typically want to hold this fund?
Yeah, Joseph, thanks first off for having me. Obviously, it's a topic that I love to discuss, and it's one that I back up with my money as it's a top 5 holding in my portfolio, and it brings that balance to the portfolio. So, which type of investor? That's what I always like to talk about when it comes to SCHD. Is you could be a dividend investor or not and still invest in SCHD, and the reason why is because it in fact brings that balance. If you're a heavy tech investor, you're going strong into QQQs and cybersecurity and AI themes and things like that, you do want to have some balance in your portfolio. And that's exactly what SCHD does, is because it doesn't have a huge exposure rate to the technology sector. So when those sectors are faltering and being slow, like we've seen in the past few months, what's there to hold up your portfolio? It's going to be something like SCHD, where it has exposure in other particular areas. So again, you don't have to be a dividend investor to be focused on SCHD.
So long-term dividend-paying stocks here, does it focus or does it focus in any one particular sector or sectors or types of business, just the ones that have that sustainable cash flow?
Right. So the requirements to be included in up for inclusion in SCHD is that companies that have to pay consecutive years of dividend payments, 10 consecutive years of dividend payments, not necessarily increasing, but they just have to at least make their payments for 10 consecutive years. You have to have a minimum market cap of roughly $500 million. And then what they do is they line up all of the companies, the components that pass that requirement from highest yield down to lowest. And then they're going to go through a set of requirements. So they're going to look at things like cash flow to debt. They're going to look at ROE. They're going to look at dividend yield and 5-year dividend growth rates. And then we're going to take roughly the top 100 companies from that position that pass those requirements from highest yield down to lowest.
Okay, so it does have that quality screener. Kind of uses that. How does it manage those stocks? Does it do this reconstitution once a year? How does it change? And basically, in the past, how have we seen that change? As far as how many are added, how many are subtracted? Does it fluctuate year to year?
Right. So there's really no human element. It's an algorithm that they follow each year. The reconstitution happens once every single year, and then we'll go through quarterly rebalancing. But no single company can have a weighting of more than 4%. It can grow up over 4%, but then all of that will be rebalanced every single quarter from that perspective there. So yeah, we go through this reconstitution. There's no human element that goes into the equation there.
Okay. I do like that 4% cap. It keeps it from too much concentration on any one stock.
Right.
Now, this year saw 22 stocks removed from the fund. Were there any general themes to what was removed? Sectors, groups of stocks? What surprised you on this list? Any of those stocks that you would consider buying on that dip?
So obviously, for any of you that have watched my channel, an individual stock, one of my longest held positions in my portfolio, in fact, is AbbVie. So although I know it's not any human that's taking AbbVie out, just like a few years ago, they took Broadcom out of it, and I didn't like that as well. But AbbVie has had a good past, 12 months or so since their past reconstitution. So that was one that I, wish hadn't got removed from it. But also I like the fact that they reduced the energy. I wasn't crazy about being overweight the energy sector with the 2025 reconstitution, and that was really a drag on SCHD for much of the past 12 months up until the past few months or so here in 2026, which really ramped SCHD in its performance. So the mentality behind SCHD isn't so much to let the winners run, but more of a focus on buy the dip mentality.
Okay. So yeah, I do like that. I like that reconstitution into out of the stocks that have run so high that probably outrun their dividend yield. Okay. So I like AbbVie as well. Great pipeline, always a great pipeline of drugs for that. But sometimes the stock price just runs so far. Dividend
Right.
doesn't keep up. That dividend yield comes down, and it's hard to call it a dividend fund if it's not providing at least a 3% yield or so.
Right.
Well, this year saw 25 stocks added to the fund. Same questions there. Was there a general theme that was added to this sector's groups of stocks? What surprised you from that? And are there three favorites among the list of additions?
Yeah, so we did see some changes. Again, the energy overall from that sector did in fact come down. The highest now is going to be consumer staples and healthcare. So then again, that talks about what I was talking about earlier. It's that great complement to those growth heavy focus points that you have in your portfolio if you are in fact a growth investor, and that could just be VOO and QQQ and cybersecurity type of funds at the top of your portfolio. SCHD is going to be there to balance it off because again, consumer staples is now at the top, followed then by healthcare, then followed by energy, which last year was the top sector focus there. You have financials in there. One area it's not going to give you exposure to is in fact going to be things like real estate. Materials was booted out, but some of the newest additions that I like, if I was looking at, hey, I would buy this outside of SCHD as well, is going to be UNH or United Health. That's one that's been beaten down. It still comes with plenty of risks, but I do like the inclusion there in terms of looking at it from a valuation perspective. Another one's going to be Qualcomm. So Qualcomm was added. Cisco Systems is the one it's pretty much replacing from the technology sector. Qualcomm's been left behind by many of the tech and chip companies per se. So maybe it can give us some life in that SCHD portfolio.
Interesting. So I like it. So United Health Group, ticker UNH, and Qualcomm, ticker QCOM, replacing some of the tech stocks there. Are there any other dividend ETFs you like, maybe even higher yield ETFs, or one that serves a different income purpose that investors might look at in addition or maybe even instead of SCHD?
Yeah, great question. So a couple that I own are going to be the likes of VIG, the Vanguard Dividend Appreciation ETF, or DGRO, which is a dividend growth ETF as well. Both of them are similar in many respects, but what they're going to offer you that SCHD doesn't is going to be that tech-heavy higher exposure rate. So if you are still a dividend investor, still focused on being a little bit more conservative, not as much volatility, but do want some tech exposure, while also still getting that dividend and the dividend growth per se, DGRO and VIG, although they're not going to give you the same amount of yield that SCHD does. And in fact, that's what makes SCHD so unique, is the fact that it has a higher yield than most high yield focused, dividend focused ETFs, and it has faster dividend growth than most dividend growth focused ETFs. So although DGRO and VIG are in fact dividend growth focused ETFs, SCHD still has a faster 5-year dividend growth rate.
Interesting. I like it. So now I want to open it up to a little bit broader, more generalized investing questions because this market has just been absolutely crazy, right? Earnings growth up 18% this year, and yet the market is down into correction territory. Roller coaster like we haven't seen, I haven't seen in 25 plus years investing. And I think it's really changed how a lot of investors are looking at their portfolio, how a lot of investors and even experts are changing the way they look at investing. I wanted to start with one of the biggest rules of investing, and that's diversification. It's always been the rule that you diversify, that you have lots of stocks over in your portfolio, so that one stock doesn't necessarily hurt you if it does come out against you. But then we see exceptions like Warren Buffett, who had 47% of his Berkshire portfolio in Apple at one point, and that high concentration in tech for the S&P 500 has helped it outperform the equal weight index over the last year. So I want to get your thoughts on this. How do you look at diversification, and has that rule changed for you?
So for me, when I'm working with any of my clients that go through the coaching program, is diversification is going to be a key topic that we're going to talk about. But we focus on it more in terms of balance. Diversification doesn't have to mean, for when I'm discussing it, is equal weight across all 11 sectors in the S&P 500. And Warren Buffett, I think, said it best, is the fact that there is such thing as over diversification. Like you mentioned there, when we are too, in fact, spread out, there's just going to be nowhere for your portfolio to go, because very rarely do we just see all 11 sectors just charging ahead and giving you fantastic returns. There's always going to be laggards, and there's going to be leaders there. So I think it's important, especially for those of you that follow the market more closely and are going to have individual stock exposure per se, is you do want to pick your spots, and you want to make sure that, number one, you're not too far over your skis. Like, I have a rule of thumb when it comes to individual stocks per se, is I don't want any individual stock to be greater than 10% of my overall portfolio. That's a rule that I just have for my portfolio. There's a number of money managers that they don't go above 5%, but I know plenty of people that'll happily go above 10%. I mean, we just saw Warren Buffett at nearly 50% when it comes to Apple there. So diversification is key when talking about balance, but I believe there is in fact such thing as over diversification. So you want to be overweight certain areas that you're bullish on, while also having some balance. Like, per se, right now, higher interest rates, we're dealing with inflation. There's not a lot of room right now after the run that small caps have seen. I still want some exposure to small caps, but it's not going to be anywhere close to being the largest or anywhere close to the largest holding inside my portfolio.
Okay. And you've touched on this. Now we know the pros of diversification. You've got your money spread out. No one stock is going to destroy your portfolio. It's really a great way to set it and forget it type of investing. No stress. You do what you do, and the stock market is going to give you those market returns. But what do investors give up when they diversify too much? And do you have a limit? I know you said you had that 10% limit. How many stocks do you think an investor should have? That's individual stocks.
Yeah, when it comes to individual stocks, question I get a lot of time from coaching clients is the fact that it really depends on you. It depends on how active you want to be in the market. Is this something where you're building a portfolio to where maybe you want to check it once a quarter? Well, then you should probably have a lot less exposure to individual stocks. Inside my portfolio, I have roughly 50 total positions. That'll include ETFs, that'll include index funds, as well as individual stocks. Most of them are, in fact, individual stocks for me. I'm in the market on a daily basis. Doesn't mean I'm making a trade every single day. I'll do options trades every single week from that perspective. But it really comes down to how active, how hands-on you want to be in terms of you and your portfolio.
Okay. And is there a scenario where you might change your mind on diversification, either for or against more diversification?
I think it depends on what's going on in the market. So if I want to clamp down and stay defensive, I'm never going to be an investor that just says, hey, I'm going to pull all of my money out because I'm frightened by what's going on in the economy, global tensions, or things like that. I'm a big believer in time in the market over trying to time the market. That has been a proven strategy over many reports that folks have looked at there. But for me, I think if I wanted to clamp down and get a little bit more defensive, that's when I'm going to spread things out a lot more evenly. Maybe not be as overweight to the tech-heavy sectors and the growth-heavy focal points from that perspective. But as we've seen, the equal weight S&P 500 is actually what has been outperforming at the beginning of 2026 here. It wasn't the S&P 500, which is more tech-heavy, but it was, in fact, having that balance across the other sectors, which is proven to show that, hey, having that balance is important in your portfolio at certain times.
Excellent. And now turning to that S&P 500,
Yep.
the Vanguard VOO or the other S&P 500 indexes, long been considered the safe investment, right? The market, 500 largest U.S. companies in the United States. They all have that international exposure. So a lot of investors use that for international exposure as well. Those 500 companies alone, 80% of the U.S. market cap, and actually 50% of the entire global stock market. So it is the market. In fact, that Vanguard VOO, the S&P 500 ETF, is the most widely held ETF. But now, with 34% of that index in tech stocks alone, and more than a third of the market cap in just 10 companies, is it really as safe or diversified as investors believe?
Yeah, great question. So for here, we've pushed a little bit more heavily into the tech sector in terms of exposure in that S&P 500. But the fact of the matter is folks always talk about, they compare VTI, which is the total market index, to VOO. And a lot of folks say, oh, this is the safest, go just do total market, VTI. But for me, in my investing style, I want that exposure into those top 500 companies because there's a lot of poorly run businesses that are out there. And I don't really want exposure to the bottom 1,000 stocks or so in VTI. I want the exposure to the Broadcoms and the NVIDIAs of the world. I want more exposure to the Amazons and let's see if the Microsofts of the world can turn things around. So for me and my portfolio and my investing style, I don't have a problem with it whatsoever, as long as when you're managing your own money, you understand where your tech exposure is. If you have VOO and then you have QQQ and then you have a cybersecurity focused and then an AI ETF, you're pushing your entire portfolio. You need to understand how overexposed you are to that technology sector, which brings us back to something like SCHD, which I call the greatest complement to those tech-heavy sectors or those growth-heavy portfolios. So again, not a major issue for me in terms of the tech exposure that we see inside the S&P 500.
Okay. And as you pointed out, the RSP, so the equal weight S&P 500, where the ETF holds each stock, each of the 500 stocks in an equal weight instead of overexposing to those largest companies. That has beaten the S&P 500 over the more recent timeline. But the S&P 500 has beaten that equal weight ETF by almost 30% over the last 5 years. That's actually 60% return on the S&P 500 versus 32% for the RSP. Is that a good thing? Is that concentration of tech that led to that outperformance dangerous? Is it something that investors should go into? And follow up to that, I guess, if someone were overwhelmingly in that S&P 500, maybe the VOO, would you suggest they add something else for more safety or add something on top of that?
Yeah, so with RSP, that's one that I like to track, but I don't necessarily invest in it. Should have been invested in the beginning of 2026. But as we've seen with the data over the past 5+ years, in fact, is the S&P 500 has strongly outperformed RSP. But why I like to look at RSP is to gauge where investors in the big money are they starting to rotate to other sectors? And RSP is a great way to find that out because of how heavily weighted and skewed some of these NVIDIAs and Apples of the world and Microsofts at the top. You could look at the index as a whole and kind of miss what's happening kind of under the ground there, where RSP being equal weighted will help me understand a little bit more. You may not know there's a sector or a bunch of companies, a gap of companies that are actually up, 10-15% outperforming the S&P 500, but their weighting isn't enough for us to understand that and see what's really happening under the surface from that standpoint there. So for me, although I track RSP, I'm still going to stay invested in S&P 500. And one comment then in terms of what I suggest adding anything else if you were in fact heavily invested in the S&P 500, and that goes back to SCHD. That's the exact setup of the top of my portfolio. The first dollars I ever invested was in an S&P 500 index fund. After that, I was looking at something like SCHD because it's the greatest complement, at least in my opinion, to that tech-heavy exposure that the S&P 500 gives us. With SCHD, you're going to get consumer staples at the top, healthcare, and energy, much more defensive. So when times are going tough for tech and growth, SCHD is going to be there to pick up your portfolio and, in fact, on top of that, give you the income component.
So I like it. A good balance there. Is there a scenario in your mind that would change your mind on this, either for or against the S&P 500 as that safe investment? Okay, is there something that might happen that you would say, no, it's not safe anymore, or conversely, something that would drive it to be really more safety for more investors?
I think for me, being a CPA, I'm a big numbers guy, and when it comes to the S&P 500, we have decades of data. And when we can't go back in time to see that, a 20 consecutive year period in the S&P 500, you will never find one instance in which we came out negative. So with that being said, the S&P 500 is a core holding, and it's going to continue to be a core holding for me, whether I'm 20 years out from retirement, 5 years out from retirement, or likely in retirement. The rest of my portfolio is likely to change, where we're going to, batten down the hatches a little bit more and get much more conservative in terms of getting closer to retirement or in fact in retirement. But I think the S&P 500 is always going to have a core position inside of my portfolio.
Excellent. I like it. I want to give viewers an idea of your investing style. If you had to pick one investing strategy, one rule or principle that you always come back to in any market, really, what would that be?
I think for me, my style is that balanced approach. I love dividend stocks. I love things like SCHD, but at the same time, I don't turn a blind eye to growth stocks. I like having that component of, hey, these are going to be my high risk, high reward. But managing my portfolio, where balancing and position sizing is going to matter. So, being an SCHD guy, being a dividend investor for, even much of my life, I still have positions like IREN in my portfolio, which is a highly speculative. I have, volatile positions like SoFi that was as high as 30 and now down to 15 and things like that inside of my portfolio. But the position sizing is what matters most. And I think for every investor, they need to look in the mirror and say, don't necessarily just follow what others are doing. Understand your strategy. What type of investor, how much risk are you willing to take? Because it may be different for the other person that's on the other side that you're following or watching on something like a CNBC or Bloomberg or Yahoo Finance, whatever it may be, or even here on YouTube, is you need to understand what type of investor you want to be. What are your particular goals?
Okay, so your goals, your risk avoidance or your risk style, as well as position sizing. Flip side of that, what's maybe one investing rule where a lot of investors follow that they probably shouldn't, or maybe it isn't worth their time?
One of the rules that I hear a lot is when it comes to just buying a stock on a dip. Buying a stock because they saw it come down 15% without doing the homework. And the fact of the matter is you're going to get burned a lot of the times if you don't understand how to do the homework ahead of time. And for me, in my investing style, what I do first is I don't actually look at valuation first. I look at quality, because my goal is to invest in high quality assets at great valuations. And when you see a stock come down 20%, it may in fact sound like a stock on sale, but when you actually go look at the results, it's actually a stock where there's margin compression. Sales are starting to slow. Expenses are increasing there. Earnings are slowing down. So it's actually not in fact cheap as you think it is. It might be a stock that's cheap for a reason. Those are the stocks that I want to not be involved with. So it's so important for you to understand when a stock pulls back, is it still a high quality stock? And you can't compare it to what it did in yesteryear, 10 years ago. You need to compare it to what it's doing today, because the dollars that we invest, in fact, today aren't based on what the company has done. It's based on what the company's going to do for you moving forward. And those are the things that you need to look at before just going out and blindly buying the dip.
Excellent. Yes, so definitely a quality filter there. I like that idea that cheap for a reason, because with the market being highly efficient, I think a lot of stocks, if they are falling, they are cheap for a reason. Very few that aren't that way for a good reason. Actually, are there any investing rules that are good to follow, but you feel like investors often misapply them?
Well, my rule that I like to tell everyone that I work with is again that one in terms of individual stock exposure. This doesn't apply to ETFs, but I think first and foremost, when building out a portfolio, foundation is key. Without a foundation, you're going to be ultra volatile, and there's a lot of folks that come in that say, "Hey, Mark, I don't like the ups and downs of my portfolio, seeing big movements in there." So you're telling me you're a lower risk investor, but when I look at your portfolio, it tells me a completely different story. So it goes back to understanding what type of investor you are. But for me, individual stock exposure is that 10% rule for myself. And I like to bring all my accounts together. I'm not just looking at a Roth IRA or my self-employed IRA or looking at my taxable account. I like to bring everything together. And from there, I want to say I don't want any one single individual stock to be greater than 10%. Again, some only keep it at 5%. My rule is 10%.
Okay. I like that. I like that idea of having rules, a rules-based investing approach, so that you can keep yourself from really chasing a stock, chasing the market, that kind of thing. Any investing rules that might sound good in theory, but then just break down completely in the real world?
For me, I like to rely on technicals, but I'm never going to buy a stock purely based on a technical chart. I'm always going to look back at fundamentals. I'm always going to look at valuation. And my approach is having that rules-based approach and combining fundamentals and technicals together. There's a lot of folks that can make a lot of money out there just purely doing it on technicals, but that's not one. I think that is one that can get a lot of folks in trouble. But for me specifically, I will never buy a stock purely based on technicals alone.
Okay, definitely. I know a lot of day traders that do well and do make money, though they spend days, they spend all day looking at their charts, creating new charts, really analyzing it. And it is a full-time job. I think a lot of investors jump into that technical side, the technical analysis, the charting, the day trading, and think that they'll just sit down to their computer for an hour or two a day and make money. And that is just not the case. Um, if someone wants to simplify their investing, then what's maybe one rule or one idea that would help that?
I think ETFs are going to be your friend. There are so many ETF options out there for every type of investor, whether you want to focus on a particular sector, whether you want to focus on a particular style, dividend stocks, dividend growth, high yield dividend. If you want to focus on cybersecurity, there's been a lot of great ETFs that Joseph has mentioned on his channel there, focused around AI, cybersecurity, and things like that. So ETFs are going to be your friend, but the thing to focus on is to make sure that you're looking at expense ratios. Don't just blindly buy ETFs. If you're getting into expense ratios that are over 1% or so, you want to be mindful of that because that eats away at your total return. But for someone that's looking to solidify their portfolio, whether you want to be hands-on or hands-off, but especially for those that are in fact hands-off, let ETFs be your friend.
I want to thank Mark Roussin. Make sure you check out his channel. I will link to it in the description below. Some great videos on investing, especially income investing and dividend stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.